In this week's update, new highs for all US indices, how to play this strength, the conflict between COVID and the global PMIs, and what happened to gold. My name's Garry Davis, and as always, this is general advice only, and welcome to 2021. And please remember to subscribe and like the video. All right, as I normally start, perspective is everything. And so let's have a look at the current perspective of how markets are positioned. We've started 2021 on a very positive note, finishing off a terrific end to the year. And who would have thought back in March of last year that the S&P and the Nasdaq would be hitting all new all-time highs by the end of the year. So it's been quite an incredible year, and it's fairly typical of secular bull markets. And we'll look at that a little more, going back to the last major secular bull market, which was from 1980 through to 2000. And it's really insightful to look back at. Yes, there were some big disruptions, but equally there was a tremendous amount of gain during that period as well. And I think we're in for something similar in this current period. So I think one of the things that seems to be coming through most in a lot of the market commentary is that this market is illogical. It's a bubble. There are all these terms being thrown around. So the question is logic out the window? Is the market just forging ahead on stimulus only? A Senate change, and whilst we've now got an equal Senate, but the Democrats effectively will control the Senate now. So a Senate change, a clean sweep, was supposed to bring a sell-off in the market because the Democrats would bring in higher taxes and impact the market in several negative ways. Well, that hasn't happened. We're also now seeing further fairly sweeping lockdowns around the world. And last time that caused a crash because it caught the market very much unawares. And that hasn't happened this time either. And the answer is that the market is really looking elsewhere. It's not looking at the consequences of who controls the American Congress. It's not looking at the COVID restrictions. It's looking further beyond that. And the economic activity data is actually coming through quite well. The global PMIs, the Purchasing Managers Index, which is really the forward-looking intentions of companies to purchase materials, is actually looking pretty good. So that's what the market is looking at. It's also looking at the extraordinary level of innovation that's happening, particularly in digital technology and also in precision medicine. It's particularly in the medical field. Some of the stuff that's going on there is almost science fiction-like in terms of the progress that's being made, but it's very, very real. And the market is getting very excited about this accelerating innovation. It's also looking at even greater stimulus, as we're seeing from pretty much central banks all around the world. And particularly the Democrats, that's a real positive as well. I guess a concern that the market may eventually reach is that now that the Democrats can have effective control and can do what they like, the market really doesn't like sharp changes or unexpected events. And with the Democrats now having total control, that is a possibility. That doesn't mean it's going to happen. It doesn't mean the market's going to react badly to it, but the odds of the Democrats doing something radical and causing the market to hiccup is certainly higher than it was under the old balance in the Congress. Okay, so just a bit of perspective. Are we in this period, so the next 10 years, could this be a rerun of the Roaring 20s in the 1900s? And at that stage, the 1920s bull market was built very much on new industries, and those new industries were industrial. It was the automobile and a number of other industrial advances, and that's what really drove the bull market in the 1920s. Well, we've now got something different. We've got this momentous shift happening in digital technology and in healthcare technology. So why could we not get a similar surge built on a radical change in leadership of the economy. And I think there's a very good chance that will happen. Now, the average secular bull market, on average, lasts 18 years. And the breakout in this one occurred in 2013. So we're only 7, perhaps 8 years into this current secular bull market. So there's every possibility, in fact, you'd have to say that there's every likelihood that this secular bull market will continue for at least 10 years. And there are a number of factors that could contribute to it going longer. So in other words, this could be a longer secular bull market than normal. But I think for this to extend to 2030 is far more probable than not. I also think we're going to see a vastly divided market. Because things are changing so quickly, you're going to see the stocks that are beneficiaries of the new environment do incredibly well at a faster and faster rate, and the rest of the market is going to get left behind. So I think it's likely that we're going to see a very, very different composition of the leaders of the market in the next 5 to 10 years. So what should we do with this perspective, which I think is highly likely? So how do we invest with the highest probability of achieving success? The first thing that we've got to do is to be on the right side of change. If you're stuck with an old perspective of how the economy should work and how markets should work, then you're probably going to be in a bit of strife. So you've got to be on the right side of change, and change is accelerating and occurring very, very quickly. We want to look for companies that have got enduring and exponential growth qualities. So it's got to be highly probable. It's got to be able to continue for a long period of time. And the growth really needs to be accelerating at a faster and faster pace, because that's what the best companies are going to do. And if you're not keeping up with the absolute cutting edge, then you're going to be left behind. Your business is going to be disrupted. So they're the sort of companies that we need to look for. And there are plenty of them around. This is not a scarcity. There are literally hundreds of stocks in the US that meet those criteria. Now, they won't all succeed, but a good number of them will succeed. The next thing we need to do is to build a plan around entries, profit taking, and reinvesting. And there's many different ways to do it. You just need to be clear about what method suits your psychology and your objectives. And if you're not clear on that, then you need to take steps to get clear, because it's really vital. If you just try and play this bull market for the next 10 years on gut feel and take it as it comes, then at the very best, you're going to get much poorer results than would otherwise be the case. I think we need to be driven far more by the charts and not by the fundamentals, because when things are changing so quickly, the fundamentals can't possibly keep up. The market is looking 6 to 12 months ahead at how things are likely to be. So the fundamentals, the numbers that we look at, are just not going to reflect that. On top of that, we also have a new world, driven by technology, where the traditional metrics of PE ratios and the like do not capture the value that some companies are generating. Those values, which will manifest themselves in a few years' time, are just not apparent on the balance sheet or the profit and loss statement. But those values are there. And, there's many examples of companies that look to be at ridiculous price levels in the 2015, 2016, 2017 year, and yet we roll forward a few years and we can see that the incredible profits they're making from those assets that no one was really taking account of back then. So the charts are really going to tell us a lot more about what's happening. But above all, we need to avoid the crowd and remain open-minded. If you fall into step with common thinking, then I can assure you, you're probably going to be left well behind. And you do need to remain open-minded and very flexible, and be prepared to acknowledge that you're not on the right track, and quickly change. So I think they're the things that investors need to do from here on in. If it wasn't important in the last 5 years, it's certainly going to become far more important in the next 5. And finally, just in terms of overall perspective, this is something that I hadn't previously appreciated, but I read just recently. And this is really just a perspective from looking at it from a demographic point of view. And this isn't the only way to look at things, because many demographic forecasters, have been spectacularly wrong. But this is just an interesting perspective that I certainly hadn't been aware of, and that is that the millennial generation is forecast to peak in terms of numbers in 2038, and it's also forecast to be much larger than the baby boomer generation, which has certainly played a big hand in driving stock markets over the last 20 years. So that's something that I don't think a lot of people have really tuned into yet. Now, the baby boomers generation in terms of numbers peaked in 1999, if what I read is correct. And the stock market, interestingly, and I'm sure it's not coincidental, entered a secular bear market in the year 2000. So again, this lends validity to the fact that this secular bull market, driven by this change and the change that the millennial generation is bringing, could extend well into the 2030s. Now, on its own, it's too simplistic a way to look at things. You can't just look at some demographics and seize on that and say, well, that's how it's going to play out. But it does raise the question: why couldn't the bull market go well into the 30s? And the answer is that there is no reason why it can't. So one of the ways of, I think, making sure that you're on the right side of change is to look very closely at what the millennial generation is consuming and how they're living. And if you can identify those megatrends and identify the best companies within those megatrends, then you're certainly going to be on the right side of change. And of course, the other thing is what will healthcare look like as well? Healthcare is just changing so rapidly. Telemedicine, gene editing, gene sequencing is just an incredible new world of science. So what will that look like as well, and which companies will be the beneficiaries? So the next decade is certain to be one of tremendous change and I think tremendous opportunity. So I go into 2021 with a very bullish outlook. All right, let me just start off by looking at some overall perspective. So this is the S&P on a monthly chart, and right over on the left-hand side here is 1965. So I'm showing the last 4 secular bear markets and bull markets, so 2 of each. So the periods marked here by the red bar are the secular bear markets. So that ran from 1968 to 1980. We then had a secular bull market from 1980 to 2000. We then went into another bear market until 2013, and now we're currently back in another secular bull market. Of course, within them, we have sharp ups and downs. And if you look at the previous secular bull market from 1980 to 2000, you'll notice that there are a couple of significant disruptions. The most notable, of course, is September 1987 or October 1987. Which was previously the biggest crash of all time. But when you look at it in the perspective of an overall secular bull market, you can see it's really just a blip on the chart. It lasted 1 month. And here in 1990, it lasted 1 month. We got another little blip here in 1998, which was associated with the Asian currency crisis. That only lasted 1 month. So we are in a secular bull market. We had a 1 month disruption early in 2020. We are going to get more of them almost certainly, but they are not periods to panic. They are periods to make some sensible adjustments and to have the courage and the foresight to buy into the turnaround, because the opportunities coming out of these sharp market corrections are tremendous. And if you combine that with only being involved in stocks that are part of these megatrends, these disruptive changes, then you've got the capacity to do extremely well. So hopefully everyone can retain this. I know when you've got a 1987 on your hands or a 2008 on your hands, it's very, very difficult to retain a clear perspective on the bigger picture. But that's what I intend to continue to present each week. And that's really the main reason that these videos exist and why I've been doing them for about 16 years, is to provide that perspective so that you don't get caught up in the media group thinking, if you like, which can be so misleading. So it's a pretty bullish outlook for the next decade, I would have to say. Let's look at the S&P now. So we hit new all-time highs on the S&P, finished at 38.25. We also hit new all-time highs on the Nasdaq. So there's the Nasdaq, new all-time highs there. And also, and this is the most encouraging thing, we also hit new all-time highs on the Russell 2000. So this is the small caps. So look at the acceleration that occurred in the small caps over November and December, and started off the new year with another bang. Now, my only concern is that these markets are running so hard now that I think we will get some sort of pause. And this week is the third Friday of the month is options expiry in the US. That always, the days just before and the week following options expiry has the capacity to get some, let's call it market manipulation, if you like. So don't be surprised to see some strange price movements in the next week. Now, if you're a medium to long-term investor, that shouldn't concern you at all. Prices might do some sudden things, but they'll very quickly correct themselves. But it is a period that you can use to advantage. You know, if you cash up a bit and use some of that cash, if there are sell-off opportunities in some of the really good stocks, then you can very much use that to advantage. So don't expect that what we've seen in the first week of January is just going to continue on and on and on, because that's just not going to happen. We are going to get some disruptions, but please remember the bigger picture, because it really is quite extraordinary. All right, there's the US dollar. We continue to fall. The US dollar has got down to support here. There's a bit of a support band between 89.5 and 88.5. We've certainly got down into that level. There was a little bit of a bounce on Thursday and Friday, but the overall direction is still down, and of course that is causing the Australian dollar to go in the other direction. And you'd be brave to say that the Australian dollar couldn't hit 80 in the next few weeks, particularly with the commodity strength that we're seeing. So the S&P was up 1.8% across the week. All the indices have got real momentum, and as I said, very impressively, the small caps are leading. So this is a very, very bullish environment in the market. The 10-year yield, and this is this has the potential to be disruptive. The 10-year yield has broken out now. Before Christmas, it was down around 0.9. We're now over 1.1, so we've had a significant increase in that yield. Now, that has consequences. So the yield is rising because bond prices are being sold. So investors are reducing their exposure to the bond market, so they're selling bonds. That creates cash. Where does that cash go? Well, a lot of it is going into equities. Now, there's a tiny sliver going into things like Bitcoin, but the overwhelming vast majority is going into equities. So for a period of time, and it's typically a couple of years after the bond market turns, it's actually good for equities. Rising yields are good for equities until we reach a certain level, but we're a long way from that level yet. Valuations, traditional valuations, to a degree, are being ignored in the market, but that's not necessarily a bad thing, because traditional valuations do not reflect some of the value in companies that can grow exponentially. So for a minority of stocks, and it might still be 100 or 150 stocks, but it's still a minority, the valuations will catch up. Their exponential growth and their investment now in sales and marketing will pay off in spades in 2, 3, 4 years' time. So the valuations, won't be an issue in a few years' time, and that's what the market is looking at. But for the majority, the valuations are really silly. There's a lot of danger out there, so you need to be very careful about the sort of stocks that you're investing in. And whilst the momentum trade has worked very well, it's certainly created some dangers, and therefore it's important to be progressively taking some profit off the table and looking to reset. Aussie stocks, our dollar almost made it to 78 during the week, and then weakened a little bit towards the end as the US dollar turned up. And of course, our dollar is being helped by commodity price strength as well, as always happens. Our index went higher by 2.6%, and some of the small caps are gradually building some momentum, but my goodness, compared to America, it's frustratingly slow. We've got terrific businesses in Australia. They're growing. The businesses are going along very, very nicely, and they're delivering what I expected. It's just the share prices are not keeping pace with it. In the States, it seems to be a different matter for whatever reason. Companies are making progress, but the share prices are definitely reflecting that. All right, let's take a quick look at the Australian market. So overall, there's the ASX 200 index. So we've broken out, and they're now moving up, and at this stage, likely to threaten the all-time highs probably fairly soon. But if we look into the actual sectors themselves, there's energy. So energy getting a lift from the fact that the oil price has gone up. Financials doing better with yields rising a little bit. That's positive for financials, so they're doing okay. Healthcare, there's certainly been some profit taking in healthcare, but net it's really just moving sideways after some pretty amazing gains back in the mid part of last decade. If we look at the materials sector, you can see BHP, Rio, Fortescue, Woodside are all contributing to a very strong materials sector. Well, not so much Woodside, that's in the energy sector, but certainly the iron ore stocks and some of the gold stocks contributing to that strength in materials. And there's the small caps. So we're just breaking out on the small cap index in Australia as well. So lots of positives around the place. It's just a matter of managing some of the shorter term fluctuations. Turning to precious metals now, gold was up strongly at the start of the week, but then there was a sudden downdraft and gold ended up losing $50 on the week, fell over $100 from its peak last week. So 1962 was as high as it got. There are probably 5 or 6 things that drive the gold price. And one of those is certainly the relationship to bond yields. And whilst bond yields have been rising, they were back in August of last year, bond yields were around about the 0.5% level, that's the 10-year bond yield. And now they've gone to 1.1. And finally, I guess the market has woken up and said, well, the gold price, gold doesn't have a yield, and therefore there is, some meaningful benefit elsewhere. And so gold was sold down. I think that is the most likely reason that I can see for that sudden move, very sudden move, and it occurred basically in the space of a couple of hours. Now, as we know, the gold price does get manipulated around by vested interests, so equally this could rebound next week. But it's certainly a pretty volatile market at the moment. Now, whilst GDX went down as well, it didn't go down by as much as one would normally expect. So I'm reading it that gold stocks are actually outperforming the metal, and that's a bit of a positive going forward. But look, the whole precious metals market is far from a no-brainer trade. If you want to talk about no-brainer trades, then it's the 5G revolution. It's artificial intelligence. It's genomic medicine, it's telemedicine. They're the no-brainer trades. There is a certain degree of risk around precious metals because there are so many different drivers, some of which can be manipulated. So anything that has the potential to be manipulated can never be a no-brainer trade. So I wouldn't be positioned too heavily in precious metals at the moment. Now, my overall bull market view for the precious metal sector is still there, but that's a long-term view. So yeah, I wouldn't be too heavy in precious metals just at the minute. There are certainly much more reliable growth sectors. So let's take a look at those charts. So we'll start first of all with gold. Well, we'll look at silver first of all. So silver also sold off sharply. So all that occurred on Friday, but you will note that it did close off the lows. So that's something, at least some support was coming in. Let's look at gold. So gold again has come back down and visited the 200-day moving average. You can see it was a pretty sharp move in both directions. And if we look at it on a weekly, we're still within the overall uptrending channel. So whilst it's volatile, and yes, that big move on Friday was a bit of a shock, overall it's still in uptrend. Sorry, wrong chart. Okay, moving on now to other commodities. Copper continues the rise that it's been in now for many months, and it's up to $3.67. And this is a very positive long-term story with copper and also with other base metals as well. Crude oil also rising. I think the Saudis have done some production cuts, and that sort of helped push the crude oil price up above 50 again. But as with gold, this remains a bit of an unpredictable and manipulated market. There are other markets that there is a lot more certainty around. So whilst the long term for commodities, and I expect commodities to do extremely well over the next 5 years, that's the part of the cycle we're in. These markets are not as predictable as perhaps some others. So there's the spot copper chart. So if you can see from the bottom in March, it's been a tremendous move from just over $2, and now we're starting to get up into the realm of the $4 area. So it's been a huge move in copper. There's spot nickel also has been rising very strongly. So we're up. Nickel is up 60% since the lows in March. And that's why nickel stocks are doing well, but also lithium stocks are doing well. Uranium stocks are starting to kick in. So there is good possibilities in many areas. So just to wrap it up, overwhelmingly the odds favour a very positive 2021. I think if you want to look at the market on the index level and measure it that way, I think 2021 is going to finish with indices significantly higher than where they are now. It's just what comes in between. I would not at all write off the possibility that we'll see some corrections in excess of 20%. That may or may not happen, but if you start to assume that it's not going to happen, then I think you're going to get hurt. So expect to see some periodic disruption, but you should see those disruptive periods as terrific buying opportunities. I think that's the most important thing that you need to embrace. And the most valuable assets that we have it's not the latest stock tip. It's having an open mind, so be flexible and be ready to act quickly and be prepared to change your mind if the evidence there supports it. Don't get stuck in a certain way of thinking. So I think they're our most valuable assets that we need to cultivate. And keep tucking away some partial profits, because there's going to be some periods where the terrific profits you've got can get tarnished very quickly. Portfolio analyst in the week coming, going to be reviewing the portfolios in America and in Australia. We've got some tremendous progress, particularly in some of the US stocks. They've really done exceedingly well in the last few months. So that's it for this week. There's more information on the website about what I do, and there's my email address for anyone that would like it. And I'll be back with you next Sunday. Cheers.